Hi everybody, it's Terry Ryder from Hotspotting, and this is my regular weekly feature, The War on Misinformation. One of the greatest causes of misinformation about real estate markets is the tendency towards generalisation. Economists in particular, but also other commentators and writers, have a tendency to discuss Australia as a single property market, which is a major mistake and causes a lot of misinformation, misleading information and analysis to be put out there to you, the real estate consumers of Australia, because we don't have a single property market quite clearly. We have many different scenarios playing out at any given point in time. I'd refer you to a chart that I use quite regularly. It's a chart with the biggest cities of Australia showing the annual changes in property prices since 1970. So it's almost 50 years of data of the way prices have moved year by year in Sydney, Melbourne, Brisbane, Perth, etc., the biggest cities of Australia. And what it shows is that in the last 50 years, we've only had 4 years in which all the major cities of Australia have grown strongly at the same time. Only 4 out of the last 50 years in which our major city markets have all done the same thing, because it's normal for our city markets to be doing different things. They're not moving as one. It's pretty common for places like Brisbane and Perth to have cycles that are quite different to, say, Sydney and Melbourne, so that when Sydney and Melbourne are rising, some of those smaller cities aren't, and when Sydney and Melbourne are down, it's quite common for some of the other capital cities to be rising. So we have lots of different scenarios playing out across Australia, but you wouldn't know it from the general theme of media coverage, which tends, for some reason, God knows why, to quote economists, because economists aren't real estate experts. It's not their stock and trade, it's not their area of expertise, which is why they get it wrong so often. But their greatest problem with them is they tend to discuss Australia as the Australian property market. Australian property prices have fallen 4% in the last 12 months, which is a nonsense, because we have many, many locations across Australia where prices are rising strongly even as we speak. So sensible analysis and sensible forecasting, because right now we've got a lot of people forecasting what's going to happen in real estate in 2019, and unfortunately, again, many of them are talking about the Australian property market and what will happen with Australian property prices without breaking it down into the different capital cities and some of the regional areas where different things are happening. Now, right now I'm writing a feature for Money Magazine. Now, this is something I do at this time of the year every year. The February edition is always, the cover story is always my 3-page feature on what I expect to happen with real estate markets and residential property across Australia in the coming year. Now, this time last year, here are some of the things that I wrote in the same feature this time last year. And I do this to emphasise that I distinguish between different scenarios playing out across Australia, and also to emphasise the point that yeah, we got it right. We're pretty much on the mark in terms of what we predicted this time last year for 2018, as I sit down to try and do the forecasting for the year ahead. Now, one of the key things that I wrote in this Money Magazine feature a year ago is that the secret to profiting from real estate in 2018 will lie in understanding that Australia has many different property markets, and some of them will be rising strongly in 2018, even as the most high-profile ones are fading. And of course, that's exactly what we saw in 2018. The most high-profile markets, Sydney and Melbourne, were fading. They went into decline, generally speaking, in 2018, but other markets were rising strongly, notably Hobart, regional Tasmania. Canberra was a strong market with solid rises in prices. We saw moderate increases in Brisbane and Adelaide, and we saw some really strong price growth in key regional markets in Victoria, New South Wales, Tasmania, and Queensland. But I'll refer to that in a moment, because one of the other things I wrote 12 months ago in the Money Magazine cover story, the February edition 2018, was this: key regional cities will be among the strongest of the nation's growth markets in 2018. Regional markets in the eastern states in particular will do well, headed by Newcastle and the Hunter region in New South Wales, regional centres close to Melbourne, like Ballarat in the north and Pakenham in the southeast, and the Sunshine Coast in Queensland. And that's pretty much what played out in 2018. The strongest markets for price growth in the past year were definitely regional markets, those ones that we talked about 12 months ago in the article in Money Magazine. Centres close to Melbourne, like Geelong was still strong, Ballarat was rising strongly, other sort of hill change towns north of Melbourne had very strong markets, and then in the southeast, outside of Melbourne, places like Pakenham and Officer and Warragul, they had price growth above 20% in the last 12 months. And then Sunshine Coast, as I forecast, it was the strongest market by far in Queensland in 2018. Another thing I wrote 12 months ago was this: Melbourne will show increasing signs of slowdown, with most of the standout growth markets being the affordable outer ring suburbs of Melbourne or regional towns not far from the city. And that again is what played out in the last 12 months. While the generalised figure that is so often published for Melbourne says that Melbourne property prices have dropped in the last 12 months, it's not true for all sub-markets in Melbourne. The cheaper areas, the outer ring suburbs, where first-home buyers in particular have been active, and also investors on a budget, have shown really strong price growth in the last 12 months. Local government areas like Whittlesea and Hume in the northern suburbs, Casey down on the far southeast, and the far west, Melton. Amazing price growth in Melton. Most of the suburbs of the Melton local government area in the far west of Melbourne had median price growth above 20% in the last 12 months. And also Wyndham City in the southwest, heading down towards Geelong. So that forecast was also in the market. Another thing I wrote 12 months ago is that Perth is the recovery market, and after 4 years of decline will show the first signs of price growth since 2013. Again, that was what played out. In the latter part of the year just finished, we started to see some of the sources of price data starting to show signs of uplift in the Perth market. The Real Estate Institute figures showed a return to minor price growth in the Perth median house price in both October and November. SQM research figures started to show some uplift, although the core logic figures differed, as they often do. But in particular, the top end of the Perth market. I mean, if you look at it suburb by suburb, what stands out about Perth is that the suburbs with median prices above $1 million, most of those showed really quite strong growth, and that is, I think, the beginning of a cycle. The top end of the market often leads the beginning of an upcycle. Another thing that I wrote 12 months ago is that resources-related towns, which have suffered major price decline since the end of the mining investment boom, will start to show price growth again in 2018, and that also was something that played out quite noticeably in the past year. In Western Australia, towns like Port Hedland and Karratha returned to price growth, and in Queensland, Mackay was the significant leader of recovery in the central Queensland centres. We also saw places like Emerald and Moranbah returning to price growth. Now, I should emphasise that they're all rising from a low base. Those locations I mentioned in Western Australia, the prices dropped massively. And Port Hedland, the median price went to about 1.2 million at the height of the resources investment boom. Then it dropped down to about 250,000. And so it's dropped down to a very, very low base, and it's starting to rise from there. So is Karratha. We've seen also in Moranbah, the coal mining town in Queensland, which at one point had a median house price of 750,000. It dropped as low as 150,000, and it's now starting to rise again. So the forecast that I made 12 months ago that we're going to see recovery, the beginnings of recovery in some of those places in 2018, that certainly has been the case. But I should emphasise that I'm not recommending that you rush out and buy in these places. These continue to be and will always be very, very high-risk places to buy. And I would suggest that most investors should steer clear of them, because more people have lost money in these sorts of places than have made money. They're very volatile. They boom, they bust. High peaks, deep troughs. It's not for the faint-hearted. Okay, so the point I'm trying to emphasise here is that in the forecast I made 12 months ago and I'm currently making for the upcoming February edition of Money Magazine is that we're not talking about Australia as a single market. We're segmenting. We're pointing out the places that we expect to do well in the coming year, and there will be many of them. And we're also pointing out the places we think are going to be moving sideways, not doing much, and also the places that we expect to go backwards. And with reference to that, I now want to refer to some forecasting by some of the other people out there. One of those is a researcher, buyer's agent, and real estate analyst called Simon Presley, who has a business called Propertyology, based out of Brisbane, operates nationally. I have a great deal of respect for his research and for his views on real estate. We tend to have similar views and arrive at similar conclusions. We have different methodologies, but we quite often arrive at the same conclusions about the places that are going to show growth and the ones that aren't. So I'm always interested in what he's forecasting. Now, he's just published his forecast for 2019, and he's, as good forecasters do, he's presented three different scenarios. I note that Louis Christopher from SQM Research also does this. Rather than putting out, here's the forecast, they put out three different scenarios which assume different things, such as, will interest rates stay the same or will they rise? Will the banks return to sensible credit policies and get back to normal lending policies, for example? So different scenarios with different assumptions. So I'm going to, in the interest of brevity, I'm just going to focus on Simon Presley's forecast. His middle scenario, he's got a scenario 1, scenario 2, scenario 3. We'll go for scenario 2, which is the middle forecasting scenario, which kind of assumes a return to sensible lending policies by the banks, which I fully expect to happen very soon. The banks cannot go on being, they've overcorrected basically in response to the Royal Commission and some of the dictates of APRA. They have to ease off because they need to lend money to make their multi-billion-dollar profits. Otherwise, they're shooting themselves in the foot as well as everybody else. Lending isn't as tight as the media's making out, by the way. People are getting loans. It's just taking a little bit longer. It's a little bit harder than it was, but a lot of people, I note that the latest figures show that housing credit 2018 is about $600 billion. It was actually a rise. It was 1.1% higher than the year before. It's easy to believe from the media headlines that investors aren't borrowing anymore. Investors can't get loans anymore. In actual fact, investors, total credit out there in 2018 was about $600 billion loans to investors, which was a 1.1% rise on the year before. It's just that the rate of growth is less than it was. So, lending not as tight as the media is making out. Nothing ever is as bad as the media makes out. But the forecast from Simon Presley of Propertyology for the major cities this coming year, scenario 2, he's expecting Hobart again to be the leader on price growth amongst the capital cities as it was in 2018, expecting Hobart prices to grow somewhere between 7 and 10%. Then we have this forecast for Adelaide, Brisbane, Canberra is sort of up to 5 or 6% price growth. Perth, he agrees with us that Perth is moving into recovery and he expects Perth prices to grow somewhere between 4% and 7%. So for 5 of the 8 capital cities, he's seeing pretty solid price growth, not boom time growth, but solid growth. And then for Melbourne, in the rate of decline in both Sydney and Melbourne, he's forecasting will lessen. And for this year, he's in Melbourne, prices are going to be pretty much very little change, or maybe 2 or 3% down in annual terms. Whereas for Sydney, he's saying prices down somewhere between 3 and 6%. Now, I note that Domain, If you've been watching the cricket, the Test cricket, you'll note that the major sponsor at the moment is Domain. That's one of the major websites where you go to find properties for sale. It's also one of the major sources of price data. And now their forecasts for 2019 were put out a couple of weeks ago, just before Christmas. Didn't get much media because it was quite sensible, moderate, non-sensational forecasts. And media is not interested unless you're forecasting something sensationally negative about Australian prices. So Domain didn't get any publicity for its very sensible and well thought out forecast for 2019. And they saw similar scenarios to the ones I've just described to you from Simon Presley of Propertyology. Domain suggested that the price decline in Sydney and Melbourne would basically bottom out around the middle of this year, 2019, and we start to gradually return to moderate price growth in the two biggest cities. Meanwhile, Domain was forecasting small to moderate growth for most of the other capital cities. Similar to what Simon Presley has done, very similar to the way we at Hotspotting see it. But you're not going to see a lot of publicity of these kinds of forecasting because it's calm, rational, expert and sensible. And none of that stuff makes it into mainstream media. It's not going to make it to the Australian or the Sydney Morning Herald, and certainly not going to be published on the rabid ABC television, which is very anti-real estate. So that's what Domain, Propertyology and Hotspotting expect to happen in this coming year. Solid to moderate to strong price growth in the smaller capital cities, including a return to growth in Perth, and a bottoming out of the decline in Sydney and Melbourne about the middle of the year. That's it for now. Terry Ryder signing off from this week's edition of The War on Misinformation. Let's do it again next week.